dollar is the most interesting thing to talk about at the moment right now. Like, honestly, over the last couple weeks, the best trade you could be in was short yen or short euro or long, some variation of long dollar. It's been literally a one-way trade. You didn't even have to get any sweat on that.
Yeah, 100%. I agree.
And when you trade FX, you can use like 10 times leverage. So 4% move in FX, that's a big boy trade.
Call it 30 times if you want.
Ben, you weren't on Monday, but I talked about a stronger dollar and the potential for a disorderly devaluation of the Argentinian peso, and how that might affect Citigroup because they've got an investment.
Oh, I love you, Charlie. That's just such good stuff, man.
Charlie and Jim, do you guys know each other or no?
We what?
I feel like I know you because I've been watching the beats, but you may not have. Okay. This will be our first time actually meeting. Pleasure.
All right, so Charlie, Darius, Charlie. Good that you guys are meeting finally.
Also, existing home sales just came out right now at 3.84 million, which is a really weak number. I mean,
mortgage rates are 7%. What are you gonna do? They got to get mortgage rates down.
Yeah. And the mortgage purchase application index this morning was down again. But it's just hard, things. I personally, and this is where I'd love to hear your thoughts, Darius, but I think there has to be some deflation in housing, whether it's material or not. I don't know. But they just affordability. I've got 5 kids, all in the house buying age. None of them can afford houses.
Does that mean that you're buying 5 new houses, or what does that mean?
I was going to say, yeah.
I already have, Nadine. I already have.
Oh.
Or just a bigger house to keep them all home in.
Yeah.
I'm selling my house so I can buy houses for my kids.
Really?
You're going to be living with them in their basement?
Exactly.
Broadcasting out of the basement. Full circle.
Are you looking for 6 kids, Charlie? Are you looking for a 6th kid?
Yeah.
Look, here's my thesis on interest rates and housing affordability. It all kind of ties into our. I feel like I'm doing a better job tying it all together. I feel like the Fed is. You ever see those tightrope high wire acts where you have to go from one skyscraper to the next, and they hold that long pole.
Yeah.
On one side of the pole, if the pole goes too far to the down and you fall off, it's the Fed needs to prevent interest rates from going too high to stop a treasury market meltdown. On the other side, you can't do too much of that because we're going to have a treasury market meltdown anyway because of inflation. It's a really hard, delicate balancing act that they have to walk, and they will make mistakes along this way. So it's kind of our job as investors to kind of start to anticipate when those mistakes are going to come. Obviously, 2022 was a kind of almost policy-induced mistake. They wanted to make the mistake because of the inflation. I think the next one won't be kind of in their control.
Yeah, Darius, I think you're right. It is a high wire balancing act. My gut is if they're going to err, they're going to err on the error of reflation. How else do you deal with the debt?
Yeah,
burden?
Same.
Yeah.
But they're going to try and
agree.
You're going to try
they're
going to try and manage it. There's no question. But
it's the game for the way out. It's the path of least resistance.
Sorry, I couldn't hear you. What?
Oh, sorry. I agree with you. The reflation is the path of least resistance. It causes the least amount of pain, or at least to the policymaker from that perspective.
Right.
You could argue that it causes a lot of pain to the sort of lower, income groups in society, but that's a different conversation.
Yeah, very different conversation. And Ben, isn't the 10-year right at its 200, breaking out above its 200-day moving average around 420?
425.
Yeah, this is the level that Silicon Valley started to create troubles for Silicon Valley. And so the unrealized losses in the banking system are now over 525 billion. So they're growing again.
The thing about the unrealized losses is I think the market's right in not worrying about them because they will go to par. But they're not going to get squeezed on those. But what I think is interesting that I've talked to Nadine and I had Hugh Henry on pod recently, and this other guy, David Levinson, was talking about. It's like the reality is when these guys need to manage their duration risk, there's no one on the other side. There's no one on the other side to short treasuries. So you're going to have a short to 10-year into a market. There's just no other side to take. So we're just getting the 10-year blowing out. And to 100%. Finalize that, I would just say that wouldn't it be funny that after 01, 02, 08, 09, and 20, where asset prices getting crushed cause fiscal expansion, that the bond market blowing up would do the opposite, would find Jesus on austerity.
Yeah, no, we might be
On
there.
that fun note, I think that we are live now. It's Wednesday, October 23rd. We're talking about Jesus and austerity. So welcome to Lost Beats with the fun crew this morning. I'm Nadine Turman. We have Darius Dale. Thank you so much for joining us. We have Ben Bry and Charlie Peabody, three of my favorite guys on the show this morning. So we're going to kick it off with Darius. He's got his fundamental research summary note out this morning. We've all read. What are the key takeaways that you really want to get across so that we can pepper some questions into you this morning?
Well, I appreciate the warm intro, Nadine. You're certainly one of my favorite people in finance as well. So thanks again for having me. I'll quickly share my screen so that everyone can kind of get a sense and read along with kind of my key takeaways here. This is our fundamental research summary. We keep this maintained for all of our clients at 42 Macro on a daily basis. Whenever there's something yellow on the page, that just means that something's changing at the margins, including the entire theme itself. So where we've been fundamentally is we've had the view that inflation is unlikely to return durably to its trend in the absence of a recession since January of 2022. Maintain that view. We've had the view that U.S. growth will persistently surprise to the upside since September of 2022, and that's come to fruition. We maintain high conviction in that as well. We have a view that the Fed has an asymmetrically dovish reaction function, in part to capitalize the U.S. government and its explosive growth in federal debt. We maintain high conviction in that. And then we are losing conviction in our most recent theme, which we authored last month, which is our Here Comes the Liquidity theme. We downgraded that to medium conviction, in part because we're starting to see a significant enough backup in real interest rates, bond market volatility, currency market volatility, and most importantly, the U.S. dollar, and what that could do to sort of slow the rate of liquidity provision or even put it in reverse over the medium term. So happy to unpack any of that.
Let's go back to that, though, just so everybody, what I love is a fast talker, but a lot of data behind it. So number one is sticky inflation, right? So you have high conviction on that inflation's going to be hard. It's going to be hard for them to get rates down to call it 2.5% because of inflation. So that's number one. Number two is that, and you've been calling it all along, so kudos to you, is that the U.S. economy is strong. And it's been stronger than people expected. We'll put a pin in that and talk about some housing stuff with Charlie later on. But that's the second thing you're talking about. But the note to that, which I think is key, is that you're expecting, and you can kind of maybe talk a little bit about like when you think that that's going to turn and what is the data that you look at to be able to figure that out. Third, you're talking about Jay wants a soft landing. So he's trying to land that plane on the water, and it's going to be hard. We were pre-show talking about that. And then, we can come back to the liquidity point, I think, at the end. But maybe you can talk a little bit is why is inflation so sticky? And then, what are you looking at to see when that the economy is turning and growth isn't as resilient?
Oh, it's an excellent question, Nadine. So it's just a real simple answer is that the reason inflation is resilient is the economy itself is resilient. When you go back and you sort of study business cycles, and I think we have one of the better empirical deep dive studies on how the business cycle works here at 42 Macro, what we find is that inflation is by far the most lagging indicator of the business cycle. And so in conjunction with our view that the economy is sticky, it's very unlikely that we see inflation return durably to trend, which it has to break down below trend in order to sort of return durably to trend. It's unlikely we see that outcome occur in the absence of recession. So in this chart, we show how each of these cycles has evolved historically in and around recession, with recession being zero. This is the median sort of path that each of these cycles has taken heading into recession in the post-war U.S. economy. Just quickly, policy tends to break down, let's call it 18 months ahead of a recession. Then the profit cycle breaks down about 12 months ahead of a recession. Then liquidity breaks down about 9 months out of a recession. Growth in the stock market break down about 2 quarters out of a recession. Then you have employment breaking down right when the recession starts. That's when the NBA dates the recession. Credit breaks down about a quarter after that. And then you finally have inflation breaking down 12 to 15 months after recession. So understanding that and understanding that there's very unlikely to be a recession over the medium term in the context of some of the monetary and fiscal stimulus dynamics we continue to receive in the U.S. economy, we have to believe that inflation is unlikely to break down durably below trend in the absence of that outcome. And by the way, one final thing I'll say is that we've never seen inflation break down durably below trend before a recession starts. So not only is this the median path that it takes, it is the path that it has always taken in the context of the business cycle.
Hey Darius, given that macro view, is there an investment theme that biases you towards hard assets? And I ask that because we've seen precious metals. Ben has had a phenomenal call on precious metals and silver and gold, but we're starting to see a breakout in platinum, palladium, uranium has had a nice run. I mean, what's your view thematically on hard assets?
Well, our view thematically is it's a loaded question, loaded statement, but our view is that we are all frogs being boiled alive in a pot of monetary debasement and financial repression. It's not the inflation that creates the demand for hard assets. In our opinion, it's the policymakers' response to inflation. And we talked about last November when we pivoted to our J wants a soft landing theme. We understood at the time that the Fed was pivoting to a asymmetrically dovish reaction function, whereby inflation is less important than all the other things that the Fed cares about, namely stability, financial stability within the Treasury market. And that response, they say a lot of things about growth and in labor market and inflation every time this guy gets up at a press conference. But the reality is, if you're paying attention, what really matters to the Fed is the volatility in the U.S. Treasury market. And they're trying to tone that down, in our opinion, has been the reason why, our discretionary risk management overlay has kept our clients alongside of gold since late October of last year.
So can you go into that, because people might not be as familiar with why they're focused on treasuries and volatility there. So can you break down for a summary, call it a synopsis for folks, why you think that they're focused on that?
100%. So this is also a loaded question that, I try to be as quickly as possible, but we are in a fourth turning regime. I don't know if we have time to explain what a fourth turning is, but just assume
do it. We all got time. I can blow through time frames. That's right.
Yeah. Okay. The fourth turning in really short terms as it relates to financial markets is we're going to see a lot of explosive growth in the public sector balance sheet. One, as a function of populism, and two, as a function of whatever the big crisis we're going to experience together at the end of this rainbow. And it's very much not a rainbow. So our view is that whatever the CBO is projecting, OMB, or whatever these extra governmental agencies are projecting on the growth of the fiscal deficits and public sector debts, those numbers are way too low. And as a function of those numbers being way too low, we understand that the only institution in the world that has a big enough balance sheet to capitalize the U.S. government well in advance of those kind of explosive growths in debt is the Fed. So we have a high conviction view that the Fed will do what it's always done in fourth turning, which is take the path of financial repression, take the path of monetary debasement and currency devaluation. And if that's the case, then we ultimately understand that the path of least resistance for the financial sort of the monetary authority is obviously through reflating us out of this sort of existential debt crisis that we could potentially be experiencing.
Okay. And so if that happens, is that dollar down? Is that dollar down, EM up, or what happens to our currency?
Yeah, well, it's dollar down structurally, but it doesn't mean dollar down in a straight line. So our general take on asset markets is, things that are more tethered to financial assets like stocks or gold or Bitcoin, et cetera, those types of real assets, homes, et cetera, those assets, at least historically, have tended to appreciate significantly in these types of forward turning dynamics. They're not going to go up in a straight line. There'll still be big cycles to risk manage, particularly whenever we have a situation where there's a big step forward in the growth of the public sector balance sheet, and the Fed is not, sort of corresponding, offsetting that with its policy. When you think about things like treasury bonds or the U.S. dollar, we were probably in secular bear markets for those types of assets. One of the things we were talking, Ben, at the beginning of this call, that we could be potentially in one of these mini drawdowns in the sense that the Fed is not, expanding its balance sheet or cutting interest rates fast enough to counter the growth of the public sector balance sheet. And if that's the case, then we're going to see contraction in liquidity and a contraction in asset markets. But again, we don't think that's the secular path. The secular path is higher for those types of assets in our view.
And I think that I shared a chart with our subscribers this week, and I plotted the index growth of the marketable debt of the United States government. And then it was a straight line from 2019 till now, up 73%. So it can't be surprising the prices are up like they are, okay? And then I did the NASDAQ and the S&P, and it was exactly like Darius' little squiggle. It was an expansion to 21, and then a contraction in 22, and then an expansion. But it oscillated around that U.S. marketable debt growth. And so I think that is the actual right insight, is that all inflation comes from money and credit growth, ultimately. Yep. And so in the old days, that was private sector credit growth. Well, I had a chart that showed that the financial sector total debt is up 13% since 2008. So those boys aren't doing it anymore. So the government's the only game in town for credit creation. And that's unlike credit where you can rein it in because, people got to pay that out of cash flow. The government is not constrained by anything, and so we get higher prices as the opposite side of that policy in essence.
100%. I got a slide to show you. This is from the Committee for Responsible Federal Budget, which is my favorite sort of non-bipartisan think tank in DC. If they're sort of they did some math on the policy proposals from the Harris and Trump campaigns, and no matter how you slice and dice it, we're going to wind up with more populism, more explosive growth in public sector debt. Both parties are effectively arguing for a gigantic increase in the size of the public sector balance sheet. If the math they did on the Harris campaign was around 3.5 trillion in incremental debt relative to baseline over the next decade, and when you sum up all her policy proposals, and that's 7.5 trillion for Trump's policy proposal. So you can argue with the actual math, but the reality is we are already on a profligate path, and that path is going to get accelerated no matter who wins the presidential or what configuration we see down in DC, because we have a belief that even in the context of a divided government, because both parties and their constituents want more populism, what we're going to be doing if in the context of a divided government is trading populist proposal for populist proposal, not populist proposal for austerity proposal. And that's a big difference and a big change in U.S. Fiscal policy dynamics.
So can I ask you a question? So you've got Elon, you got Tesla reporting today, and Elon's all over the place, not always just because of Tesla, because he's sided with one of the candidates. Is it possible that there is any incentive for the Republicans, and this isn't a political statement, this is just watching what people do, not what they say. Is it possible that they would want to cut spending for any reason or not? Like, would they want to be cutting, or is this only going to be going up?
I got a very hot take on this. I think Elon, and he's probably going to kick me off Twitter for saying this, but I think he's full of poop on that particular topic. You can't cut enough quote unquote government waste to make a dent in the government budget. What we show here is our fiscal policy monitor, where we keep clients on tabs on all the different dynamics and moving parts in the fiscal balance as we get the new monthly budget statement every month. And when you look at the things that actually move the needle, and what we would consider to be anything over 10% of the federal expenditures, it's health and human services, it's income security, it's Medicare, it's national defense, it's net interest and Social Security. Those are the things you have to cut. Most of those things are entitlement spending. And they obviously you can't cut the interest as well. So the things that the executive branch has control over in isolation, you're talking about drops in the bucket relative to what is a very unsustainable path of fiscal growth. Now, again, I'm not saying this because we are on an unsustainable path. We've been on an unsustainable path from a fiscal policy perspective. That's not new. What is new is the fact that we're in a fourth turning, and we're going to have another big crisis to deal with that requires a complete mobilization of public sector resources, which causes even more explosive growth in the fiscal trajectory relative to current baselines. And that's why we think to enter the Federal Reserve in terms of helping the U.S. capitalize that.
I have a little different take on that, which is
Sure.
The CBO came out with a report that 2 to 3% of GDP is just fraud and waste. Okay. And if you think about, and I've been an NVIDIA bear, so let's just keep this clear. But one thing that AI could do is improve tax collection, improve the fact that fraud, machine learning works by clustering. And you're like, oh, why are we paying $50,000 for a toilet to Lockheed Martin? So it wouldn't be necessarily at the level of, okay, how much should we allocate to which group? It's like, let's squeeze the margins, let's improve tax collection. And then if you layer on tariffs as a revenue line, and then one other thing I would say that should be acknowledged is that if the government is able to lower rates, every 100 basis points is $100 billion, and 40% of the debt is within 2 years. So, you can drop that interest bubble down to 500 billion. I mean, there's a lot of different ways that they can give the same amount of populism, which I do agree with that assertion. I don't think the people are going to accept less, but I think that you can run a tighter ship, and that can be incrementally back. And let's be clear, the guys who are on the gravy train, the winners from this current system, they don't want the party to end. So you can totally understand why they're anti that, And so I don't know. I feel like your view is theoretically correct, but like everybody seems to have that view now. It's very consensus, popular view. Everybody loves gold, S&P forever. Bonds are the worst thing ever. It just seems like everybody's on one side of the boat at the moment. And so I'm always a little weary that sometimes things can change. And one last thing, our boy David Dredge I was talking to him last night. He said that if Trump can convince the people that deficit reduction and reduction of issuance is good, he will be the God King. I thought that was quite funny, but it's true. If he can convince people that deficit reduction is what they want, it will be quite something to see, I guess.
Sure. I agree with everything you said, especially about the part about everyone being on one side of the boat, because I do want to pull on that thread. But I also believe that Trump is a byproduct of the demand for populism in the United States of America, in our opinion, largely as a function of us sending all of our jobs to China and Mexico. Right?
Yeah.
We have a whole
agree,
left behind class of people that really are kind of marginally connected to the workforce. This chart here, we show labor share of national income, which is down on the lows, much lower than it had been for decades and decades prior to the kind of China joining WTO in 2001, Mexico joining the NAFTA in 1993, and the offset of that is we've got corporate profits up at the highs. And so that, is basically relative to the previous trends. There's been about a 400 basis point swing in the amount of gross national income that has gone from the household sector to, as a wealth transfer to the corporate sector. And that's about, 11% of the median household income on an annualized basis when you kind of do the math. And so there's a lot of folks, and it's not everyone sharing that burden, same. There are people who are just completely out of the labor force now, and there are people who've actually made all that money. So we've created quite a dichotomy in the economy from a political standpoint. And in my opinion, I think Donald Trump is just a symptom of that dichotomy that's been created, as opposed to kind of leading the charge on populism.
And one thing
before we go there, wait, Ben, I want to go back to define something, because I don't think we really defined it well. Is the fourth turning, because that underpins some of your thought here. And that's obviously like the Strauss-Howe generational theory that call it 20, 21 years, there's this, generational persona, if you want to call it, that deals with social, political, economic, whether it's a mood, climate changes. So what is the fourth turning? So if you can kind of define that for people, because I think it's helpful to hear people's views, but to get behind, why is that causing some of this?
Yeah, absolutely. So this is some of the best, if not the best, research I've seen. So it's going to be hard to explain in 2 seconds, but I know,
but that's what I'm trying to do.
I'll give you a 1 minute summary. I'll give you guys a 1 minute summary. So the theory is that, sort of basically at the length of every long human life, there are, sort of 4 different turnings. Each turning corresponds to a generation coming of age. And so as a function of that generation coming of age, they look around and see a political world that is increasingly disconnected from what they want. By the time you get to the 4th one of those, the entire system is just completely not working for the class coming, the generation coming of age, and they start to demand big societal changes, big changes to institutions, not just how the government works, but how the economy works, how the U.S. sits in the rest of the world, how it interacts with the rest of the world. And so we are, in our belief, again, I defer to Neil Howe on the actual empirical research behind this, and which again is some of the best research I've ever seen. We are in a fourth turning, have been in a fourth turning for about 15 years. It's Neil's belief that we have another 8 to 10 years to go in this fourth turning, and by the time we get towards the end of that 8 to 10 year window, we are going to have a significant rejiggering of U.S. institutions, if via fiscal crisis, monetary collapse, total war, pandemic, meteor hitting, global climate change crisis. I don't know what the crisis is. Neil doesn't even know what the crisis is. And one of my former mentors, or one of my mentors, no one knows what the crisis is.
What does that mean? Does it mean that Mr. Beast and Taylor Swift are running things, or what does it mean?
Say what?
Does it mean that Mr. Beast and Taylor Swift are running things, or what does it mean then? What are they demanding?
What do they demand? Well, they're demanding new institutions that work for them, as opposed to work for the political elites in society that are currently confiscating all the income and wealth, at the sort of corporate elite level. I mean, we have a society that I think we can all agree is broken for the average American. That's why we have Donald Trump and Kamala Harris running for president, and not Elon Musk and Darius Dale. There's a reason that people are demanding those people. It's because the
Although I
system.
think Elon is running, but anyways, that's a totally different show.
Him and I could run in like the 90s where everything's fine and we all agree on everything. This is not one of those times.
Nadine,
Yeah. Okay.
Can I take some of this macro and come up with some micro suggestions?
Yeah. Yes, please.
Because I think our listeners are interested in individual stocks as well. Listen, for the last 2 months, I've been on this kick that espousing the idea that you should be selling, if not shorting, things that need to be financed. And that by that, I mean things like homes, cars, RVs, boats. And so names, like Polaris or Brunswick Corp or Harley Davidson or the Home Builders or, the Auto Nations. Those, what we've seen, and Darius, has alluded to this, is we've seen a tick up in rates as inflation concerns have come back and fiscal profligacy, makes its way into the mainstream. And yesterday we had Pulte Homes announce earnings. They beat on both revenues and earnings, but they guided lower on, and they missed on their gross margins. And that's been, the theme behind all of these things is affordability is just horrible right now for boats or cars or houses. And so you either have to, imply incentives, as in the case of what Pulte Homes was talking about yesterday, if you're going to meet your sales goals, or you're going to miss your sales goals. And that theme of gross margin deterioration is starting to play out throughout all these different names. So Polaris was down 9% yesterday. Pulte Homes was down 7%. Most of the home builders were down 3.5%, 4% yesterday. And I think people are becoming aware that, when the Fed started cutting in September, the whole rate structure from the 5-year out to the 30-year has gone up. And then this morning we've got, existing home sales at 3.84 million, which is a 14-year low. And the mortgage purchase application index declined this week as well. So affordability is a real problem right now. And I just don't see how these guys are going to get to their sales goals without cutting prices, which means margin deterioration. Anyway, I'll stop there.
No, but I want to go back to that a little bit, right? Because what you're saying is big ticket items need to be financed. So let's just say that the Fed does cut, right? The Fed does cut, but people are fighting. I know, but let's say they cut more because it's obviously not helping enough, right? They have other costs that aren't in CPI. It's property taxes, tips, interest payments that obviously could go down. Mega Millions being 2.5 times the amount before, right? Marijuana, speeding tickets, you kind of like get all these things that aren't in CPI. And those might not go down. So like, can you roll forward what happens if the Fed, it doesn't sound like they will, but let's say they did cut another 50 basis points. Does it change things or do we still keep having this problem?
Are you asking me or Darius?
I'm asking you, Charlie.
Oh, darn. I was going to put that on Darius. No, I think the yield curve steepens the more the Fed cuts. And I think that's going to be the regulator that tempers how much the Fed can do. Another play on this, obviously, is you've got to free up the banking system to buy more treasuries because of the amount of issuance. And so one of the plays is that, they take off the asset cap on Wells Fargo so that they can, be another player. The other, opportunity is for them to change the SLR, supplementary leverage ratio requirements on the banking system so they can, increase their leverage or capital capacity to buy treasuries. So Darius referred to the idea that the government's going to try and regulate rates to the extent that they can, and the marketplace allows them to. And so there are things that they have up their sleeve that they can do. But at the end of the day, I just think that it's going to get more costly to finance, those type of assets like boats and cars and houses. And therefore, you have a deflation in housing coming. How big it is, I don't know, but I think you have to change the affordability structure if you're going to meet sales goals.
Because mortgage rates are 7%. I mean, so if the 10-year is 4.25, it's 275 bips against that level. I mean, how much wider can the spread go? So even if we have a 5% 10-year or 5.5%, I think fair value of the 10 years 5.5 to 6. Okay, it's dramatically under where you would say this is the fair value should be. Well, okay, it's pricing that in already. To me, mortgage rate spreads are usually 150 bips over the 10-year, 125 bips. We're there already. So the true 10-year is our buddy George that Nadine loves. Was on our pod. He's been talking about the true risk-free rate is really 5.5 to 6, and the mortgage rates are telling you that. So it's like, I don't know. I just think the 10-year itself is at risk more than it is the mortgages. I mean, you're right. As long as this dynamic stays, you're going to keep having a dead market, right, Darius? I mean, the housing market is like dead.
You're singing the best music to me, man. I completely agree with you. That's why I said hot potato earlier. Well, hot potato Nadine's question, but it's also hot potato as it relates to the global financial sector. We completely agree with you, Ben, that the 10-year yield is not 4.25. It's close to 5 to 6% in our view. We go about that math in a completely different manner by adding back the mean level of term premium that is currently missing from the bond market. You go back and you look at, study term premium from 1960 all the way to basically the post-crisis era. Term premium averaged at about 150 basis points. You add that term, and the reason it doesn't exist anymore is because of the size of the Fed's balance sheet, their asymmetrically reaction function, the negatively sloped forward rate curve. All those things are causing investors to are sucking term premium out of the bond market. Well, if you add it back, you got a 10-year yield this morning of about 5.72%. And that has significant implications for economic signaling. You're talking about a 10-year TIPS break-even rate that's closer to 4% as opposed to closer to 2%. And you're talking about a positively sloped 3-month 10-year Treasury yield curve at about 108 basis points versus minus 40 basis points currently. So I completely agree that the bond market is being weighed on, if you will, by this sort of asymmetrically dovish reaction function by the Fed. And the mortgage rates reflect that. The rest of the world, the asset markets broadly reflect that, in our opinion.
On the rate structure, I mean, 4.25 was on the 10-year yield was where Silicon Valley started to run into trouble. I know, Ben, you have some thoughts on this, but if we're going to 5.5%, a lot of these regional banks are going to get whipsawed in their interest rate swaps because they've been putting on swaps anticipating much lower rates. And I would point out the system right now, the unrealized losses in their investment security portfolios is probably over $5.25 billion. We'll be up to $6.5 billion. I mean, $650 billion. If we get over 5%. So some of the problems that existed, back in 23 are going to resurface. The question is, does the deposit growth continue to emerge, or are we going to see deposits leave the system? And if we do see deposits leave the system, then those unrealized losses are going to matter. If we don't, then I think people will ignore those.
So when do we short the KRE? Is that now in advance, or are we waiting for something? That's really, at the end of the day, the folks watching, I see the eye climbing up here minute by minute. When are we shorting the KRE?
I think the rally into the new year continues, so I'm not yet on board with that.
Patience. Charlie's patient man.
But I think a lot hits the fan in 2025.
Got it. And Darius, how about you? When is growth slowing? What are you looking at? Is it the labor market? What are you looking at for slower growth?
Growth, because I think the economy is going to hang in there and be fine throughout all this process. And part of the reason that the rates are where they are is because the economy is fine. To me, it's really about as a function of.
I think I'm losing you.
Oh, that's a good picture of them. Well,
yes, that's good. Yeah, it is a good victory moment here.
Can you hear me?
Yeah, we got you, man.
Lost you for a little bit, but are you looking for slower growth, like the labor market, or what are the signs you're going to look at, or do you think that, man, this just is chugging along even throughout 2025?
To me, it's liquidity. So when you go back and you think since the post-crisis era, the market's only really gone down for two reasons. One, you had a decline in global liquidity, or you had a refinancing air pocket, or both. Right? That's typically what causes markets an issue in this sort of fiscal dominance regime that we've been in since 2008, in our opinion. And so, you in that context, to me, it's all about what are the kinds of things that could unwind what is currently a very, sort of sanguine outlook for global liquidity. And if you think about the things that could potentially unwind that, you're talking about interest rate spike, which we're currently experiencing, a breakout in bond market volatility, which we're currently experiencing, a breakout in the US dollar, which is currently experiencing, and a breakout in currency volatility. Those are the four dynamics, in our opinion, that could really cause a significant trending risk-off market regime, next year. We think that stuff will happen as we have a view that Trump's probably going to win the election, and he's probably going to get a significant amount of his policy proposals pushed through, and those policy proposals will eventually wind up in causing a trending trending moves higher, and all those dynamics, which are causing a trending move lower in liquidity. We are not of the view that that's going to happen starting from today, but it very well could. We have to continue to execute our risk management systems and be careful and mindful if they start taking down risk in the coming weeks.
Well, perfect. Well, listen, thank you so much for joining us today, Darius. And as always, I love having Ben and Charlie on. That's it for Wall Street Beats. Check us out. You can read more detailed notes from the team. Got to be a subscriber for that, but you can catch us every day on the show, Monday to Friday, and we'll see you back tomorrow. Thank you.
Thanks, Darius.
Thank you, guys. That was awesome, man. I wish we had more time. We could have gone on another hour.
Yeah, I could have.
Yeah, why did the moderator cut us off? What was that?